What are the fundamental problems for running your business from the UK when it's a US company?
Strap in. Two main items: central management and control. That is the thing I see in your scenario where an individual comes over and you might have a 100% owned LLC that owns a holiday home or runs your consulting business or whatever it might be. The UK, in the same way me and you, Aidan, we can't just set up a Delaware company to start doing work, because HMRC turns around and says, but you guys are here.
Alex, hi, good afternoon. How are you?
I'm doing very well, Aidan. How are you?
I'm not doing too bad. Thank you so much for coming in today.
Delighted to be here on your podcast.
So you are a partner at Blick Rothenberg, and you specialize in entrepreneurs and business owners, particularly within the US team at Blick Rothenberg. And so you are the perfect person to talk to about this topic today, which is businesses and their owners migrating to the UK. What are some of the complexities that you find dealing with entrepreneurs and the owners of businesses, as opposed to dealing with individuals thinking about the US-UK space and relocation in particular?
So I think with relocation in particular, I think there's a lot of focus on the individual tax, particularly in the last year or so with the change to non-DOMs. And actually, everyone's then, from a personal tax perspective, very focused on kind of the foreign income and gains regime and that perimeter around an individual. So when an American comes to the UK, they're very focused on what is UK versus what isn't. The problem is that if you're an entrepreneur or business owner, where does that perimeter start and end? Because actually, for many of them, they are in the UK still doing something substantive for their business. And it's actually how we then navigate those two parts, as well as also entrepreneurs and owner managers, particularly in a domestic US climate. The gap between the individual and their business is very blurry. And then actually, once you move to the UK or you move anywhere cross-border, you now have to be very regimented in how you manage the risks of that situation as well as the taxes.
Yeah. So we're going to largely focus on sort of small businesses, sort of 1 to 10 employees maybe, and more specifically, the individuals who own and run those businesses, whether they are themselves an employee or not. It's worth noting at the outset, one of the things we're not going to discuss on this episode, because there is an entire episode about it already, is the issue of limited liability companies and the UK taxation of them through this idea of the Anson position, which goes to the point you made about the difference between the way the US and the UK look at the distinction between the personal and the business. I think for these purposes, for the most part, the issues we're talking about are going to be generic across all corporations. So whether you run a C Corp or an S Corp or an LLC, that's not to say there aren't other issues that arise. And I'm sure you're sick to the back teeth of talking to Americans about things like the Anson position. But we're going to think about a business in the sense that both the US and the UK would consider as like a corporate business. How does that sound?
Sounds great.
So let's start with probably the same place we start with for individuals coming to the UK, which is, well, when do I need to start thinking about these things? When should I start planning for these things? And we've discussed on this podcast previously the statutory residency test, that we ideally want to think about planning in the tax year before we come to the UK, etc. But with some aspects of corporate structuring and corporate tax, residency and tax residency status aren't always the only things we should be thinking about. So what is your sort of general guidance to people about when they should start thinking about the ownership and structure of their business if they are anticipating a move to the UK?
I would obviously say before you move to the UK, but also it isn't as simple as day one, you're American, day two, you're UK, and you turn one tap off and the other tap on. We know in real commercial situations and in, for people moving their life, it's never as binary as that. But what I would say is having a bit of foresight of your move and actually understanding what risks you're trying to manage, particularly in that first few months. Because for sometimes, if you're working on one day in, say, New York, and then the next week kids are in school in the UK and you're now just working from the UK, well, you probably want to have a plan for what that looks like. I think there is also within the US-UK tax treaty, there are certain activities you are allowed to do cross-border. So, of course, we love the pre-planning, That isn't going to be black and white for all people. And I think I'm sure you're the same, understanding what your client wants, understanding what they're going to do, and then working with them to basically put a bit of a plan to mitigate whatever cross-border risk there might be. If we can have at least the initial conversations, in advance of any move, we can kind of hopefully cover off most of the real self-inflicted mistakes that can sometimes happen.
I mean, it's also worth pointing out, and my immigration colleagues would want me to include a strong statement here.
Oh, please.
We're talking about tax here. As an owner of a business looking to come to the UK, unless you're a UK citizen or the spouse of a UK citizen wanting to come on a spousal visa or something like that, there aren't as many options for relocating to the UK than when there were, say, 10 years ago. And expanding your business into the UK or starting a UK subsidiary, some of the things we will talk about from a tax perspective on this episode. The immigration and visa part is entirely separate. So I guess that can also be a point at which someone should be thinking, oh, well, I'm already planning how to get there from an immigration perspective. I should also probably be dovetailing that with the tax side.
That is one of the first questions, because if your answer is, I'm just here as a tourist, or I'm here for business meetings, go get immigration help first, then come back once we know what that is. And actually, a lot of times, the type of visa someone comes here on actually might dictate how they structure their business, whether it's a subsidiary, whether it's a sole trade, whether they have to pay themselves or not. Depending on the restrictions of the visa, it kind of actually might push you down a certain route with regards to how that's structured.
Yeah. So let's take what is probably the largest issue I see as the lawyer involved in this process, and I wonder whether it's one that you see as a tax advisor as well, which is, I'm the 100% shareholder in this business. I'm also the CEO, and I'm the most influential person within this business. And I've moved from the US on the 1st of January. I've moved to the UK, and now I'm going to start running my US business from the UK because I've not really thought about what the consequences of that will be. Can you talk through at a sort of high level, I'm sure we can go into some more detail, but what are the fundamental problems for running your business from the UK when it's a US company?
Strap in. two main items and they kind of go in this order. Number one, central management and control. That is the thing I see in your scenario where an individual comes over and you might have a 100% owned LLC that owns a holiday home or runs your consulting business or whatever it might be. The UK, in the same way me and you, Aidan, we can't just set up a Delaware company to start doing work, because HMRC turns around and says, but you guys are here. And that's exactly what they're going to say to your hypothetical client. When they are in the UK, essentially what HMRC will go is, are you exercising the central management and control of that business from the United Kingdom? Because if the answer is yes, we're going to treat it as ours. That applies to any company, whether it be your business, a holding vehicle, an SPV to kind of, if you own, doesn't need to be American, any company in the world. If you're developing a holiday home or some investment and you are the sole owner of a corporation, HMRC can say, we think it's a British company.
Because speaking sort of conceptually, you're in the UK, you're enjoying the English, the British landscape that lets you run your company, you've got your kids in school, you should be paying your way for the services you use. And it would be too easy to allow someone to enjoy the fruits of living in the UK whilst running their business from overseas, but the business paying no tax despite the fact that it's benefiting from having a presence in the UK.
Exactly. And also the fact that it is where you exercise the effective management and control of the business. At
a director level, importantly.
At a director, yeah. I always think of this as sort of governance, sort of a governance test. So in your example, as the 100% owner, CEO, founder, what you probably need to think about is, as the 100% owner, exercising a lot of control, you might need to think about giving up some control because you need to have board meetings. You need to have decisions challenged. You need to conclude contracts, and all those kind of real high-level governance issues need to be outside the UK. So in a more established business or a more mature business, you might have a C-suite or a board of directors. So that the fact, if you're the COO of this business and there's a board of 4 people, and you happen to say to your other co-directors, hey, I'm going to move to the UK. My spouse is British, so I can get the visa. I'm going to move in July. Can everyone accommodate me working from there? The first question is actually, of course we can, Aidan, but we need to put some belt and braces around, you can't start concluding contracts on your own unilaterally. You can't start having one-person board meetings where you have unilateral control. There needs to be a lot more rigorous governance.
Yeah, there's no rubber stamping, because if you'd resigned as a director and you have a notional director in place in the US, but that director is still accustomed to taking decisions from you, they are acting as what we would refer to as a shadow director, which is probably the coolest name in tax law. As a shadow director, HMRC would say, no, it's still being controlled from the UK because the American sort of puppet is nothing more than that.
Yeah, and I think with that is, sometimes it is do you have a family member or someone that can take over? But yeah, you're absolutely correct. It's got to actually be substantive, and there's got to be evidence of board meetings and of effective debate.
Yeah.
There has to be a level of debate around decision making that's minuted, that's actually happens, as opposed to exactly your shadow director. The other thing to think about when we have is actually what does the business actually do? Because you running a 5-10 employee business and you being the sole director and you move to the UK takes a lot more control and management than it just holds an asset, like a plot of land. Because actually, how many board meetings do I need to have every year for a company that owns one plot of land? So again, understanding exactly what the business does. I think with all of anything central management control related, it's based on the facts and circumstances. There is no, dear Mr. or Mrs. HMRC, can you please rule whether this business is managing control?
Unfortunately not.
So therefore, it becomes basically risk mitigation and risk management, depending on what the business does, what your activities will be, and what guardrails you can put around it, so that if HMRC were ever to ask, hey, you seem to be a director of this business, can you explain what you do for the business, that you can then stand behind that the business is not managed and controlled in the UK.
And it's it's important to say it's not every decision, because lots of businesses will have lots of levels of control and subcommittees, and people delegate to various employees. Your marketing director might live in the UK. That doesn't mean that just because the marketing takes place in the UK, that particular element of your profits or anything like that is going to be controlled from the UK. But it's where the strategic decision-making takes place. It's the board decisions. If the board collectively is being controlled from the UK, that is what is going to give rise to central management control.
And, you might ask, what is the problem of being centrally managed and controlled in the UK?
Alex, what is the problem with being centrally managed and controlled in the UK?
Well, essentially, you get treated just like a UK company. You have to register with Companies House, disclose all your directors, disclose your beneficial owners, file statutory accounts, file corporation tax returns.
See, what's interesting there is, and it's funny you put this around because I'm really glad you did, nothing you said there is the other side of the equation, which is pay UK corporation tax. Because a lot of the discussions I have with people is less about the tax, because it might be we use the treaty, it might be we get relief, but I say, do you want to tell HMRC about your worldwide affairs? If you're controlled from the UK company disclosure requirements are relatively high compared to certainly America. They've sort of moved towards us, but we shouldn't disregard the reporting obligations, putting aside the tax.
Imagine if you were the other American shareholder of this business, and you might have been the silent partner or the investor, and your name's going to be plastered all over Companies House because Aidan decided to move and run the business from the UK, as well as disclose your financials. So the reporting is a real pain. The other thing, which is unique, or not unique, but it's part of the US-UK treaty, is the US-UK tax treaty for residency does not have a tiebreaker provision for companies.
This is true.
So if you are UK resident, UK wants its corporation tax on your profit. The US is also going to tax it because it's a US corporation. And essentially it says, go to competent authority.
Everyone's least favorite thing.
Oh. So therefore, if you're a multinational, you might go to competent authority to get a ruling to avoid, to allow offset of double taxes. But if you are a small owner-managed business, you're not going to competent authority.
No.
You need to take advice beforehand to mitigate the risk of ever being in that situation.
I mean, to be clear, when you're talking about competent authority, you're referring to which country has the right to tax you and which country has the right to claim a credit. In practice, one or the other of those countries is going to win eventually, but you need to know which is the country that will take the tax. Otherwise, you risk having to pay tax in both countries until they resolve the issue, but that could take years.
And many other treaties that the UK has a tiebreaker, which is where the place of central management is. So if it was a UK-Spanish company, for example, checks UK-Spanish tax treaty to double check. If you were a Spanish company managed controlled in the UK, their treaty would say, okay, so you're both going to tax the corporate profits. Oh, but the UK gets the first right and Spain has to give a credit. The US-UK is exactly the same. You just get into stalemate. We're both going to tax it until someone tells us who gets the primary taxing right.
I mean, even if we end up in the perfect scenario where we know exactly who has the primary taxing rights, and I come to you as a experienced advisor of corporate tax, the way in which tax is computed in the US and the UK is very different. The amount of deductions and reliefs that you get, I know that's the case on the personal level. I'm assuming that corporations in the US have more reliefs and ways to write down their profits than in the UK, and you can end up with vastly different amounts of, putting aside the sort of exchange rate, vastly different amounts of tax to pay, even where you have an idea that one country has the right tax first.
Yeah, capital allowances versus depreciation is a classic example of that between two countries. The other thing to bear in mind is also the US-UK tax treaty is a federal treaty. So if you're doing business in California, New York, New Jersey, they don't care whether you are UK manager controlled. They want their state tax. So again, you have that. So not only is there double taxation, the actual effective tax rate, even if you were to get relief, does rise. So I think, we'll say number one here for the governance, but central management and control is such a key point that I think is sometimes overlooked, particularly when you get into conversations where, particularly if there's a client who's, let's say, moved for work or moved for, with their employer, but they happen to own, with their sibling an investment or have a holding company where they haven't put in those sort of guardrails around the governance.
One last point before we get on to what I'm anticipating is going to be your second of two big topics, was just to be clear, when we're talking about control, we're talking again about directorial control. We're not talking about shareholder control. So if you are the silent business partner, in your example, maybe you're the silent business partner who comes to the UK, and the only involvement you have with that company on a day-to-day basis is through your act of being a shareholder, that is itself not enough to provide central management control. You're going to AGMs, you're doing all the things that members or shareholders of businesses need to do. That does not constitute control, even though that might be an involved process, because you're not a director, you're not performing an executive function.
Exactly. And when you talk to your clients who are moving to the UK around what are you going to do in the UK, a really good answer sometimes is you're going to do nothing. You're going to do nothing for that business because the people back home in the US, they can keep running the business. If you can get a dividend every now and again from a very successful business, good on you.
Or if you absolutely can't change the structure, you're so integral, you're going to have to get used to, I say flying Concorde. Concorde doesn't exist anymore. You have to get used to flying business class to the US and then conducting all of your business and minuted very carefully, as you pointed out, when you're in New York.
It's the transatlantic equivalent of London City Airport to Luxembourg on a Monday morning.
So let's go to, I'm assuming the second of your two big topics was going to be permanent establishment?
Yes. So if you've managed to take advice and put those guardrails around the governance, build a board of directors, or you have a board of directors. So, hey, Aidan, hey, Alex, no, this business is not going to be centrally managed controlled here. Then it's great. Excellent. Good answer. Question number two. But what are you doing here?
Yeah. You're going to go to the UK and maybe, I don't know, with this successful US company, we sell widgets. But maybe we want to sell widgets in the UK. So, Aidan, you're going to go to the UK and you're now going to sell widgets in the UK for us. It's fine. You're not controlling the business from the US, so there's no corporation CMC issues, but you're going to now start talking about permanent establishment.
Absolutely. And ultimately, you are a senior employee, senior person in the business. Maybe you design, you manage, you might be part of a very senior role there. And what is it that you are doing in the UK and how should that be structured? So let's take a step back. So there are certain activities which creates a permanent establishment in the UK. And what I mean by permanent establishment is where the UK says, hang on a second, that non-UK company is doing something that we think is material in the UK.
It's generating revenue, which may then generate profit, which is being done from the UK, and we may want to tax those profits in the UK.
It's doing something that's either revenue generative, it's either actually doing something that's very fundamental to doing business here. And therefore, they say, wait, you can't just come here and just run a business from the UK and us not be interested on it. And therefore, if you do nothing, what the HMRC's view is, your US LLC, C corporation, whatever it is, you have a branch in the UK. You are doing business in the UK. Can you register your branch with HMRC? Disclose who owns your branch and all the financials, so all the stuff before. And once you have a branch in the UK, essentially, you have to attribute profit to it. And that becomes a question as to, well, if we make 100, but the CEO is living in the UK, how much of that 100 of profit should the UK get to tax versus how much the US gets to tax? And that takes you into the world of transfer pricing. And we're not going down there today.
We haven't got the time.
We haven't got the time or expertise.
Or, frankly, the desire.
But it takes you down into transfer pricing and how you allocate the profit, which isn't to say having a branch is necessarily a bad thing, because actually, well, we want to do everything right. We are creating a branch in the UK. We are creating profit in the UK. Therefore, we'll register the branch and pay UK corporate tax. And actually, because it's due to a permanent establishment, there should be a credit back in the US for any UK tax that your branch pays, against federal tax at least. I think what the natural next step from having a branch is, wait a second, we still have to report our US company on Companies House, register a branch, do all that stuff.
Because even there's only a branch in the UK, that still pulls the entire US company in.
Exactly. For reporting purposes, for disclosure purposes.
You're going to now tell me how we can do a slight bit of cauterization and a slight bit of segregation between the US and the UK.
And that is creating a UK subsidiary.
Which is, I mean, just putting a pause, any multinational company that you've heard of that has offices all over the world, this is how companies avoid creating worldwide disclosure nightmares. And you have these lovely organization charts with lots of lines and squares and shapes going everywhere because lots of sub-companies held by parent companies, etc., is because companies incorporate second sort of subsidiary companies within each territory they practice in.
And a lot of the time, those subsidiaries are not necessarily for tax purposes, they're actually for legal purposes. Even something as simple as, imagine in your example, you come to the UK, you're the CEO, but you also do some UK sales, which HMRC will think those UK sales are from your UK branch. So therefore we want that to be our profit. Well, what if you messed up the VAT registration or treatment on those sales? Well, without a subsidiary, it's the whole group that's subject to HMRC's investigation and on the hook for penalties and what have you on VAT. So a lot of the time you have the local subsidiary just for limited liability purposes to ring fence that risk. It also then means we're using a local company for liability purposes in a local market. When you've got employees, customers, etc., if your widget, explodes or is faulty, you then have that protection in your local market, which is why those structure charts have those subsidiaries where you do business. But it's also thinking about at what point does being in the UK flip from I'm just here for a meeting to I'm actually now doing business here. And that, I think, when it's the owners of the business, the founders of the business, it doesn't take very long for that, because you are what they call in the treaty a dependent agent. So if you can bind the company, if you make sales, if you are the guy doing the business, well, you're doing business in the UK. If you take the job you're doing in the US and you do it here, you're now doing business here. Whereas if you are, let's say, the CFO, or if you are more of a non-exec or a consultant, it might not be as straightforward. There might be a time period where you have to show that you're consistently doing business in the UK. There's some certain things you can do which do not rise to a permanent establishment, such as marketing activities. If you're over here to scout a potential market, if it's, if you're non-core, if you're, I think the phrase ancillary to the main trade, those won't rise to a permanent establishment. But again, it goes back to trying to figure out what is your client doing in the UK, or what do they want to do in the UK, what do they need to do in the UK.
Is there any reason why, putting aside the ancillary versus core argument and maybe putting aside the administrative inconvenience, is there any reason why you wouldn't set up a UK subsidiary company? I mean, it seems to be so frequently the answer that we go to. It seems to be so universal as a solution. Are there any pitfalls, strapping in slightly for the nerdy bit? I'm aware that whenever we talk about Americans and businesses, and you alluded to it at the beginning, we may not be comparing apples with apples in the US because maybe this particular entity is a pass-through entity and profits are attributed to the shareholder directly. When we start interjecting foreign corporations into a group, there's going to be a greater risk of double taxation somewhere on the way in which profits are allocated and distributed throughout the group. In your experience, notwithstanding that potential risk, incorporating UK subsidiary tends to be, on a kind of international planning level, not just with Americans, but even with Americans, the way to best shelter and insulate the UK element from the wider international practice.
I think that's correct, Aidan. I think where you see branches is generally where the US structure itself is passed through.
Right.
And it's usually passed through due to commercial considerations. So, for example, if you're an international law firm,
mm-hmm.
They will commonly have branches and be overall a global partnership. So they wouldn't necessarily have subsidiaries. Equally, you could still have subsidiaries, and not for today, but where you make check the box elections on them to make them pass through for US tax. But for most entrepreneurs, a UK limited subsidiary is generally where you end up with.
Mm-hmm.
The other option that we sometimes see is actually whether the person moving to the UK and the employer or the US business goes, Aidan, you want to move to the UK? How cute. Go figure out your tax.
Yes.
Don't drag us into this UK
We're going to come
stuff.
to that a bit later, yes.
Right. And that's where you might set up, you might become an independent contractor,
mm-hmm.
or you might have to then set up your own company, etc.
Mm-hmm.
But they kind of go, that's now a you problem.
Yes,
that's not our problem. We're an American business. Don't give all the other owners your UK stuff.
Delving slightly into corporate structuring 101, let's assume we have this classic scenario of the US, let's call it a C Corp, as a parent, and its subsidiary is a UK limited company. The UK company is producing profit, it's paying tax on that profit, it's doing VAT, it's doing everything else it has to do. It's now sitting on profit that it wants to send back up the chain to its parent. At a very high level, because I appreciate there are swaths of legislation that deal with this, how does that profit get dealt with in the US and the UK from a tax perspective when a UK company sends up its profits by a dividend to its US parent? And how does the treaty help us?
So I think ordinarily, where a dividend is declared from a UK company to a US company, the UK is a pretty friendly place when it comes to dividends to non-resident shareholders.
There isn't any.
Exactly.
Tax actually said there isn't any.
Very friendly.
Yes.
Which is super helpful. The one thing to bear in mind, though, is from a US tax perspective, that subsidiary is likely to be a controlled foreign corporation.
CFCs.
Exactly. And therefore, the US corporate parent will need to consider the artist formerly known as guilty.
This are the changes that President Trump brought in the end of 2017.
Which has now been further amended by the OB3 last year. So now net CFC tested income, which I think people are going with NICT.
Okay, we'll go with NICT. It's fine.
NICT, I think, is what some people are going. Necktie is the other one out there. It was the thing known as guilty.
Yes.
I think is what most people know it as. So then, the parent would need to be aware of what foreign profits they have from their foreign subsidiaries. And that is not just the UK, but any other non-US companies they have. But broadly, if you can avoid tax under the CFC regime in the US, then the repatriation of profits to the US isn't actually that bad because the UK is pretty friendly. The problem we sometimes see is actually the other way around.
Mm-hmm.
If it's a UK business going into the US, that's where the US is not as friendly to non-Americans.
You shock me.
And actually, on corporate structuring 101, how we repatriate those profits becomes very interesting depending on ownership groups. Because as much as you might have, a US office and a UK office, and they both make profit, actually in your structure, kind of which way round you want them and how profits get repatriated. And back to our good old friend transfer pricing as to how much profit you have in each of those locations. Sometimes you will have, if it's a non-treaty country, the US can withhold 30%.
Which is a lot.
For corporate to corporate, it can be 5% under US-UK tax treaty. You could get 0% if you meet the real deep qualifying conditions regarding qualified owners, which is a very technical area, and I don't wish to go into. I'd need to
put in the box with transfer pricing.
Put in a box with transfer pricing. But it's very much an area where I think businesses coming to the UK is generally a little bit easier than structuring into America, because America just has that extra burden for repatriating profits, where the UK is kind of okay.
Well done for giving the entire answer without once talking about checking the box on the UK subsidiary, which I've never really understood, but people in your profession keep telling me is a thing you can do sometimes.
Yeah, you can do that. It depends kind of what the business is here to do.
So one last point on this CMCPE, Central Management and Control and Permanent Establishment topic, which is one that I think gets frequently missed, I think also by people in the private client space, let alone the individuals, which is the value of incorporating subsidiary. Central Management Control, if my client has moved to the UK and then decided, you know what, I've done everything I need to do in the UK, I'm going to go back to the US now. What happens if my centrally managed and controlled company and its owner leave the UK and go back to the US? You're going to tell me it's absolutely fine. There is nothing more for them to worry about, and HMRC just waves them on their way. No.
I think it wasn't clear enough that being centrally managed and controlled in the UK whilst being a non-UK company is a bad thing. So imagine the example. We tell this potential client or client, central management control of your US LLC is really bad. There's all this paperwork and there's corporate tax and everything. And the client goes, but it just holds like some land. It's not got any income. Leave me alone.
Yeah. I've only been here 3 years. I'll tell you, I'll just go back to the US.
Yeah. I'll fill in the paperwork. It's just paperwork, right, guys? But when you leave the UK, there's an exit charge. So an exit charge, so a corporation tax charge on that UK resident company now no longer being UK tax resident. So you might be absolutely right. He owns a plot of land, has no income, doesn't have a business, doesn't have a trade. It just sits on that plot of land. If you really hate yourself and you want to do all the filings, so you go, I don't even care, I'm going to do all the filings because I don't want to appoint my brother to the board of this LLC that owns a plot of land. What could be the problem here? And then 3 years from now, I'm leaving the UK. That could be a deemed sale of the land because the company is now leaving the UK tax net, presumably holding an appreciated asset.
It's kind of like an expatriation as a US citizen. They're levying one last chance to tax the assets, the profits, before they lose the rights to tax them afterwards. They want to have one last sweep up.
Yes, it's like many countries have exit tax for individuals.
Like Canada.
Yeah, it's basically like that for a company.
And we have for trusts in the UK as well, we should say. So these sort of holding vehicles, these sort of separate tax structuring vehicles, you've got to be careful. And I always joke to people, coming into the UK and importing these structures into the UK is usually a tax-free move, but you've got to be very careful because the export of these structures is the one which absolutely hurts.
I would assume those situations are people who maybe haven't taken advice and we're speaking to them after they've been here a number of years, as opposed to someone planning into that.
No, you would never plan into that. So the last bit I want to talk about on the corporate side, which is quite a big area, and so you can tell me if this is worthy of more time in the future. You are a tax advisor. You are not an accountant. I will inadvertently refer to you as an accountant many times. But one of the things that as an accountant, my brain thinks you do is helping with lots of the company accounting things that come from having employees. And when you expand into a new territory, there are lots of things that come with having a place of business in a foreign country and having employees, things like payroll and pensions and benefits and all these kind of things. And sometimes people in your profession talk to me about things like employer of records, EORs. Can you talk through, if I'm the US business, and let's say I do everything sensibly and I set up a UK subsidiary, or if I don't set up a UK subsidiary, what does that mean for the internal accounting and operation of that business vis-a-vis its responsibilities to its employees, for example?
Yeah. So if you take an example of a US business that sells widgets. So you've got widget manufacturing people, you've got widget salespeople. But let's say your tax manager decides to move to the UK.
Someone who works for the company.
For the company, and they're part of the internal finance team.
Sure.
They're not part of the core business of the... So therefore, arguably, that person isn't doing business in the UK. So they're not a dependent agent. They're not binding the business. They're also not making sales, setting up a warehouse for widgets or showroom for widgets or doing anything selling widgets. They just happen to log into their computer from a different place.
Yeah.
So therefore, if you're in a US company, we don't have a place of business in the UK. Must be all good, right? But you still have an employee running around the UK, working for you. You can't just have employees in other countries with no consequence. So that's where, sometimes you might use an employer of record, which essentially is, we need to do some payroll, some HR, some pension stuff, whatever.
We're an American company. We don't know what that is for UK purposes.
And we don't want to know.
No, it's probably cost you more than you have to pay that person.
Yes. So therefore, that's where an employer of record comes in to take over some of that payroll, HR, all the good stuff that a UK company having an employee in the UK has. You can do that without having to set up a subsidiary and have to file books and have a footprint.
Taking sort of one example, the thing that probably most impacts a payroll department is withholding tax at source, PAYE, pay as you earn, which most employees, the overwhelming majority of employees in this country, are on as a scheme, and which means they don't have to file a tax return, which is not the case in America. So suddenly this idea that you as an employer are withholding tax at source is a bizarre and unusual mechanism to have to get your head around. And so needing to find someone to do that, either internally or in your case, you mentioned earlier, go find out and do it yourself, is quite tricky.
It is tricky. And I think there's also, you talked about earlier, there's that line between whose responsibility is it? Is it the employers or the employees? And, we've got many clients who they moved to the UK. They still get paid out of a US company. They had a chat with their employer and their employer went, yeah, cool, off you go. We'll keep paying you.
You wanted to move.
Yeah, you want to move, carry on. Well, but they might carry on paying on a US payroll with federal withholding for at least for a period. Mm-hmm. And, particularly, during the COVID pandemic when everyone was everywhere just working, right, this came up a lot. But if you're, let's say you come to the UK, Aidan, and you just moved to the UK and you're on US payroll and there's full federal and state withholding, but you're still logging in and doing your job over here. If you were my client, we would obviously say, well, all your work days are in the UK, you're working here, you're earning here, pay some UK tax.
Yeah.
And by the way, on your US taxes, if we can get the timing right, we might be able to get a credit, might be able to use a foreign earned income exclusion, we might be able to avoid the double tax.
My brain wants to say overseas workday relief.
If you were spending time outside the UK, absolutely. Although it is now capped under the FIG regime.
Yeah, I saw. Yeah.
I don't know if you've got another FIG special coming up on this.
Was there an employment-related FIG special? We can talk about whether work done in the UK for a US company is foreign situs or not. You're going to get me very excited, Alex.
Oh, but then you're out of pocket for UK tax, and then you've got to go claim a repayment of your US withholding. But at some point, if that's 1 year, 2 years, 3 years, number one, you might get a bit fed up of having no cash in your pocket and waiting for the IRS to repay you your US federal taxes. And your employer, well, shouldn't they be doing like your national insurance for you?
The job of an employer.
And therefore, it's always a little bit of, at some point, there needs to be a bit of coordination between the individual. Because actually, if you're paying HMRC, the tax on your work that you're doing here, you can then go, I'm clean. I'm paying all my tax where it needs to be paid. That doesn't necessarily mean that your employer is paying all the tax they need to pay. They might have national insurance, need to run a payroll, et cetera, et cetera.
I was going to ask you about national insurance, but I didn't want to make it, I didn't ask it in case you were like, God, don't ask me about national insurance. Would I still have to pay national insurance if I'm employed by a US employer but based out of the UK?
If you're here, you're paying national insurance.
I'm paying employer and employee national insurance?
Yeah.
Good luck explaining that to an American.
Obviously, UK national insurance, particularly employers' portion, is pretty expensive, particularly compared to the US. So, and by the way, veering into the world of global mobility here. So, ask a global mobility specialist. But sometimes when you're on assignment or when you are working overseas, you might want to apply for a certificate of coverage, whereby you can stay on your home. So in this case, the US Social Security regime, and therefore be exempted from the UK national insurance regime. And there are usually two reasons why people do that. Number one, if you're an employer sending someone to the UK, well, the UK one looks pretty expensive. Can you get certificate of coverage? So we save money because it's a lot cheaper. It's not 13, 14%. It's like capped at 9% and then about 2 or 3% thereafter. Or secondly, if you're a worker and you've got a number of years of US Social Security contributions, unlike the UK, you can't voluntarily pay in to the US.
But you need to catch up.
Yeah, you can't pay to catch up in the US scheme like you can for UK national insurance. But also, the US Social Security is so much more generous than whatever the UK state pension is.
Which is not something we talk about very frequently when we think about American benefits, is it?
Oh, it's a socialist
utopia
over there. But so if you are someone, who is spent most of your working career in the US, actually we are seeing quite a lot of these people. You spent most of your working time in the US, you're coming back to the UK later in your career. You've not been here for 10 years, so you qualify under the foreign income and gains regime as well. But actually, a couple more years of US Social Security contributions could get you a much, bigger pension at the end of it than paying 3 years of national insurance, for over here, or how many years you're going to be here. So again, when it comes to employment-related issues of cross-border employees, national insurance, Social Security is also important. And by the way, that equally applies to someone who's the CEO of their own business, as well as someone who's just moved over here and doing almost like a remote role.
You mentioned before, if you were advising the employee, from their perspective, this is we're sort of shifting towards the end of the podcast towards thinking about the employee. Does it make a difference in terms of your job, whether they're employed by the US parent or the UK subsidiary? Because we see this quite a lot with people coming over and I'll say, who you're employed by. And sometimes they go, less so for the owner-managed business. This might be more relevant for the large tech firms coming out of California. And I go, oh, you're now over in the UK working for insert large tech company here. And like, who are you employed by? They often don't know. Does it make your job easier acting for the employee if they're paid by the UK company, if they're an American?
I think mostly if you are coming over here on, with a large employer, our responsibility is to make sure the person we're speaking to pays the right amount of tax. How they've structured that employment, I imagine there are some, multinational, international corporate tax whiz kids who have figured that out.
Undoubtedly.
So therefore, there will be a reason why someone is through an offshore employment center. So it might be, some random employer services company, which then has a branch in the UK to operate the UK payroll. But that's kind of how they transfer price their own services back. I think that where it gets a bit more tricky is those more SME style arrangements where actually it's do I continue to be an employee? Actually, do I need to become, and Americans use this phrase, do I need to become a 1099 is what the Americans say to you, which is, do I need to be an independent contractor? Which is essentially what a lot of businesses in America domestically will have. But you just do it from the UK. And then actually our conversation then switches to, so Aidan, you're going to be a contractor back to your US client. Should you do it as a sole trade? Right. Should you do it as a limited company?
You're going to talk about IR35.
I hope I don't have to talk about IR35.
You don't have to talk about IR35.
If you look like an employee, quack like an employee, you're an employee.
Yes, yeah. I remember this. The last question I want to ask, and you'll forgive me trying to take my advantage where I have it, because it may be, again, another topic for another time. Very frequently, where we're dealing with the employees of these multi-jurisdictional US and UK structures, for example, people aren't just getting paid in cash. They're getting paid in a variety of deferred comp and restricted stock units and share incentivization schemes and all of these very, very exciting things.
It doesn't sound very exciting, Aidan.
Does it not?
Your voice was not very exciting.
You're the tax advisor. Can you, in very broad terms, talk about the complexities that can arise in a US-UK context, particularly where we're talking about ownership incentives with like an American business, but when working from the UK? I intend in the future to have a much deeper dive into this, but at a sort of fundamental level, thinking about the employee's perspective, how does being paid in non-cash remuneration make your life more complicated?
So I think it adds complexity with regards to, there are probably some arrangements where you're already locked into an arrangement in a vesting period, and then you happen to move countries. There isn't a time machine to go back and make your UK 431 election at time of award, because you didn't know you were going to be in the UK at that point. Also, if you imagine a large US corporation where you are receiving awards of US stock, I think that will be subject to potentially UK and US taxes, depending on where you were over the various qualifying periods. And I think that particularly if you are cross-border working, go back to what you said earlier about overseas workday relief, actually getting overseas workday relief on some of those non-cash awards, as well as also just sourcing based on workday information. So what we say to people is figure out exactly what your deal is, keep really good records of where you were, what you were doing, and if you've got some information from the internal teams at your employer as to what they think you've got, because ultimately when it comes to non-cash awards, generally you do have to be aligned with your employer, because certain elections that you make actually changes the tax treatment as an expense for your employer through their local payroll, whichever country they are running it through. So I say it's a whole topic in itself, but it gets complex. But I think it's, if you have those sort of schemes, making sure that you are on the front foot around getting all the information and then taking it to your lawyer or compensation expert or tax advisor to be able to then advise on it. I think where we sometimes really struggle is there isn't a true understanding of what the scheme is, particularly, if you are just looking at it from a US lens, because it's kind of a magic beans I get awarded every so often, and they've got X number of hurdles to hit, and they somehow get to value it really low. I don't know how. I think understanding truly what that plan is can then help us advise.
Something carried interest, something shadow income, something waterfalls. It's all very complicated.
Yes.
Look, it's been immensely helpful. Thank you. I know I've asked about a very wide variety of things. Hopefully people have been sufficiently scared into making sure they go and speak to Blick Rothenberg before they expand their businesses into the UK, or at the very least, if they're listening to this whilst already here, they are picking up the phone as they speak.
I don't think it's scaring. I think it's
forewarning,
but also actually understanding the individual circumstance, because I think it changes so dramatically between, if you imagine if it's you owning 100% of a business, which is just you, it's like an S corporation, ultimately you might turn around and say, do you know what? It's my business. I'm the only person. It's my risk. I'm going to structure it this way. I'm going to keep it simple, or I'm going to have to keep that and structure. But that becomes one approach versus, I'm actually I'm a co-founder and we're going through a fundraise, and I'm really worried I'm going to bring due diligence risk and commercial risks by being here, or IP creation in the UK. And it's really understanding kind of the difference in the business, because then we can tailor our advice as well as also understand what the parameters are. Because as much as on paper it might be, do you set up a company, do you set up a branch, do you set up a sole trade? Actually, there's nuance around all of them. So we're not here to scare, but I think it's helping entrepreneurs and business owners manage that risk of being cross-border.
You're right, that sounds much better than scaring. Alex Straight at Blick Rothenberg, thank you so much for joining me today.
Thank you very much, Aidan Grant at Collyer, Bristow.